Just to introduce myself a little bit, my name is Peng, and I'm the Associate Academic Director of the Master in Finance program. So I'm mainly in charge of the Master in Finance program in Singapore campus. Okay, and so I think I'm going to skip this one. I'll mainly talk about our Master in Finance program today. I'm sure many of you have heard of ESG before, and if you want to know more about our ESG business school in general, you are welcome to go to our course website. Okay, so I'll mainly talk about the Master in Finance program. Okay, so here, this gives you an overview of our Master in Finance program. As you can see here, we have a very long history in conducting the Master in Finance program. We have several programs in the past, but now everything is combined into one. We call it a Master in Finance program now, and it's accredited by the French Ministry of Higher Education at the M2 degree. And our program is highly ranked. It's ranked by number 4 globally by Financial Times in 2022. Okay, and the program is offered on both our Singapore campus and our French campus. The curriculum is going to be very similar. Okay, even though the course structure are different, but the curriculum are very similar. I'm going to give you more detail about our curriculum in just 1 second. And also, I'm going to show you later that we have 3 tracks of programs in the Master in Finance program. So as if you have heard of our Master in Finance program, you probably know that the program is really career-oriented, and it's a really diverse and international program. The program is also highly selective, and at the same time, it's also very, very intensive, because the program only lasts for about 10 months on campus, then 4 to 6 months of internship or academic dissertation by the students. So we want the student to absorb as much knowledge as possible. So as a result, the program is a very intensive program. So usually we start the program at the end of August every year. Okay, and we'll offer a lot of core courses as well as large number of elective courses. And also, because our program is offered on both our Singapore campus and the French campus, so the students can also choose to exchange between the 2 campuses in January. We have 2 parts of the program, 9 months on campus and 4 to 6 months of internship or academic dissertation. So for the 9 months on campus, we have 4 different terms: T0, T1, T2, and T3. So for T0, it's basically we call it the preliminary term. Okay, so basically the students will take some of the fundamental courses just to prepare the students for future courses. So for example, students will take like a financial theory, statistics, foundation in calculus and probability, as well as accounting refresher, again, just to prepare students for future finance courses. And at the same time, we do acknowledge that the soft skill of the students are super important in the financial industry. So as a result, we also have like a team building and the leadership. We also have negotiation skill program for the students as well. And at the same time, as you all know, that the program is career oriented. So we do provide a lot of training in terms of how to find a job in the financial industry. So for example, we have invited alumni networking consulting company to teach the students. We also have this career service in-house career service team to train the students as well. Okay, so basically for the first week of the program, students will spend most of the time in learning how to find a good job in financial industry. And another highlight of this T0 is we also organize study trips in T0 to London. So students on both Singapore campus and the French campus are invited to go to this to join this London study trip. Okay, although it's optional for all the students, but students are invited to go if they want to go. The study trip is over 2 days, so students will visit different banks in different banks in London. Okay, and also they will attend MIF alumni networking events in the London area as well. Okay. So the second part of the program is T1. So T1 will generally be speaking from October to December. Okay, so it's a full term. So basically it's 3 months, and we offer different fundamental courses in finance. So for example, all students are required to take a programming in Python course. They will do corporate financial management. They will do financial market, economics, research method in finance. And also in T1, students will choose which track they want to follow. So we have 3 tracks: corporate finance track, financial market track, as well as fintech and analytics track. So if you are doing the corporate finance track, students also need to take financial accounting and reporting course. For the financial market and the fintech analytics track, students will do options. Okay, and another highlight of the program is we do try to build connections for the students with the financial industry. So we host this introduction seminar to financial careers, in which we invite a lot of financial professionals to come and talk to the students. On one hand, they share with the students what they do on a daily basis, what is their insight about the industry, what they think, what the skills required for different jobs. Okay, and also on the other hand, it can also help the students to expand their network. So this is another highlight of the program. And of course, if you are joining our Singapore campus, you also have the chance to join the study trip in Singapore as well. Okay, so this is going to happen in T1. And the elective courses we offer in T1 include international finance, financial modeling with Excel, geopolitics and Islamic finance, private banking, real estate finance, the same trade experience François just introduced to you, as well as some other elective courses. So this is a T1. So then in T2, it's another full term, which is from January to March. Remember, for the students in Singapore campus, they have a chance to exchange to French campus in T2. Similarly, for the students who joined the French campus, have a chance to come to Singapore campus in the beginning of T2. Okay, so for this T2, it's going to be a very specialized term. So meaning that the students will take advanced and specialized courses in finance. So depending on the track, they will have different courses. For example, if they are doing the corporate finance track, they will do firm valuation, M&A, as well as financial system analysis. If it's financial market track, they will do fixed income, portfolio theory, and investment analysis, as well as advanced derivatives market. If it's fintech analytic track, they are going to do financial econometrics, digital financial platform, and fintech, business data science, as well as machine learning. Okay, and then of course we also offer quite a number of electives to different students. Some of the common electives include commodity market and energy products, financial risk management, ESG investing and sustainable finance, alternative asset. Okay, and at the same time, so for example, if you are doing corporate finance course, the corporate finance track, right? So these are your compulsory course, but the compulsory course of the other two tracks can serve as the elective course of your track. The same thing for the other two tracks as well. Okay, so that means students have quite a bit of flexibility in determining what courses they want to choose. So T3 is going to be a short term as well, meaning that it's going to be a 5-week term. So it's usually run from the beginning of April to the middle of May. Okay, this is also the last term on campus. So all the students will do ethics seminar because we do emphasize the ethics standard in the financial industry to the students because we think it's really important. And then for different track students, they will take different courses as well. So for example, for corporate finance track, they will do project finance, private equity. For financial market track, they will do corporate treasury and the markets, derivative pricing and the trading. Then for the fintech analytics track, this is a very special track in T3 because in T3, the students will only take an ethics seminar as a course. For the rest of their time, they will work on a real project. We call it capstone project, meaning that the students will work on a real project in a financial institution. So for example, we have been working with Société Générale, we have been working with BNP Paribas. They are both big banks in France, right? And we also work with some other financial institutions as well. Okay. So then the elective courses in T3 include the VBA programming for finance and sequential prediction, optimization, and investment, etc. Okay. So for all these courses, the fundamental courses are usually taught by our ESG faculty because we really want to build a really solid theoretical foundation for the students in T0 and T1. But then for the courses in T2 and T3, they are more advanced, they are more applied courses. So most of them are taught by a financial professional. Most of them are very senior professionals and they are very experienced, very knowledgeable in their field. So the purpose for this one is to make sure our students, the knowledge our students learned can be applied immediately when they start their internship or when they start their full-time job. So another highlight of this T3 is we also organize a study trip this is a 1 week study trip. Okay, this is the main study trip. So this 1 week study trip is compulsory to all the students. In the past, we have gone to Hong Kong and New York. In fact, before COVID, we always organize a study trip to 2 destinations. Okay, so students can choose either to go to Hong Kong or go to New York. Okay, so now, as you know, as most places in the world, it has phased out the restriction due to COVID. We hope that we can organize the physical study trip again in the near future. Okay, so the program I just mentioned is mainly a 1-year program. As you can see, students spend 9 months on campus, then they do 4 to 6 months of internship, right? So that is mainly for the so-called 1-year program. And the 1-year program is for the students who have done 4 years of study after high school. For most of them, it means that their bachelor is 4 years. Okay, so then they can join our 1-year program. But then we also have some students who has only done like a 3-year education after high school because their bachelor is only 3 years. So that means they can join us for 2 years. Okay, so for the 2-year program, the first year, for the first 3 months, okay, so again, they are going to join us at the end of August. So for the first 3 to 4 months, they are going to study on campus. Then for the second half of the year 1, they are going to do a 6 to 8 months of internship, as you can see here. So then in year 2, they are going to come back in T1 and they are going to join the 1-year program, basically. Okay, so I'm not going to go through detail for this 2-year program, but you understand the structure. Okay, so just to summarize some of the key points for the program. So our students not only is not only able to take many courses in the finance program, okay, but also they are able to join the study trip. They are also going to join the finance forum as well. So if you look at the destination of the study trip I have mentioned, we'll organize study trip to 4 destinations. Basically, these are the 4 financial centers in the world. Okay, so at the end of September, we organize a study trip to London. Okay, sometime in T1 from October to December, we organize a study trip in Singapore. And then in April the next year, we also organize a study trip to London or New York as well. Sorry, to Hong Kong or New York as well. Okay, then of course, depending on the situation in different country, sometimes we need to change the destination, but we try to expand the students' network, expand the students' view about the financial industry as much as we can. Okay. So ESG really emphasized a lot about the ties with the financial industry. So as you can see, not only we organize the study trip, but we also invite a lot of financial professionals to teach in the program. We also invite a lot of speakers talking to the students. In addition to that, you know, ESG also have several faculty industry chairs, which is sponsored by the different financial institutions. For example, we have an ESG Amundi chair. We also have another chair, which is sponsored by EXA, which is on sustainability finance as well. Okay, and ESG is also a CFA program partnership. ESG is also a CFA program partner. Okay, and every year we offer 15 scholarships for the CFA exams as well. Okay. And of course, our career service team also organize, you know, like a career fair where a lot of companies will join us on campus and to expose students to different opportunities as well. Okay, so here just to show you some of the speakers we have invited in the past for the Master in Finance program on Singapore campus. So as you can see that many of them are very senior professionals. So in the last 2 years, every year I invited about 20 to 30 speakers to talk to the students. So again, to make sure students know very well about the financial industry and know exactly what they want to do in the future. As I also have this dual degree with University of California, Berkeley. Okay, so this is mainly for students with engineering background. Okay, and then if they want to do a double degree with between ESG and UC Berkeley, they are more than welcome to apply to this program as well. Okay, so this is just to share with you some information about our career service team. Okay, so for example, before the students arrive on campus, they will provide the CV correction service. And as I mentioned, we also have this alumni consulting company, which is specialized in helping the students to find a job in investment banks. So we do have them to teach the students for 4 sessions. Okay, and they will share a lot of tips of how to find a good job in the investment banks. And in the same time, we also have in-house career service training. They conducted many workshops as well as a mock assessment center. So for example, they will conduct a workshop on how to write your CV, how to do interview, how to network, how to use LinkedIn, etc. Right, and also they will conduct a mock interview as well as a mock assessment center. Again, just to prepare our students for job market. So you are probably curious about, the career perspective of our students. So this is the information we get from the Financial Times Master in Finance Career Experience 2021 ranking. Okay, so as you can see here, 96% of our students found a job within 3 months of graduation. Okay, and 82% of them hold a job with international functions. Okay, and also you can see the different jobs they do. Okay, by function. So some of them are doing sales structuring, some of them are doing like project management and asset management, investment banks, project finance, private equity, venture capital, M&A, and consulting, etc. Okay, and also this one show you the different sectors they have. Different sectors financial industry they are working in. So some of them are working in banks, 42%, and some of them are working in brokerage firms and investment fund, consulting, asset management, insurance company, etc. Okay. Yeah, so this is more specific about our Singapore, the students from the Singapore campus. So this is based on the information of 2016 to 2019 cohort. So again, you can see here, 6 out of 10 work outside their country of origin. Okay, and 45% working in Asia and 55% work in Europe. Okay, and if you ask me the most recent data, so for example, last year we had over 50 students, and about 30% of them found a job or full-time, either internship or full-time job in Singapore, and then the rest either go back to their original country or they found an internship or full-time job in London as well, London, Switzerland, and some other financial centers in Europe. Okay. Okay, so this is just to give you some information for who can apply. So we are looking for students with a bachelor or master degree from disciplines such as engineering, science, mathematics, business, as well economics. Our 1-year program are open for holders of a 4-year bachelor or master degree. Okay, and then our 2-year program opens for holders of a 3-year bachelor degree. So the admission is based on the following criteria. So academic record and the curriculum, professional experience, motivation, recommendation letters, as well as your actual curriculum activities. Okay, and we usually require management aptitude test like GMAT, GRE, Touch March if you are from France. Okay, and also the English test required is one of the 3. Okay. And also, if you are keen to talk to someone and to know more information about the program, you can also talk to our program advisor, Mr. Johnny Liang. Okay, and he will share a lot of information with you. If you are not sure whether you should join the 1-year or 2-year program, or if you are not sure what you want to do in the future, feel free to contact Johnny, and Johnny will find the right person to help you. Okay, thanks everybody for your attention. I'm looking forward to seeing some of you in the future.
That was Professor Peng Xu, Professor of Management Practice in Finance at ASEC Business School. Next up, we have a special mini masterclass with Stefan Ullrich, a Senior Vice President at Eurex.
Hello, everybody, and thank you very much for joining us today. I have to apologize for now. There's a bit of a technical. Here we go. Now I can start my video. Thank you very much. It's a great pleasure to be here today. And thanks for joining in for the session. As Sul just mentioned, my name is Stefan Ullrich. In my day job, I am a Senior VP for Sales at Eurex. That's a European derivatives exchange covering fixed income and ESG. These days, that is a thing that can happen. It's my pleasure to give you a brief, like a snapshot as to where we are today with regards to sustainability, sustainable investments, how that all came to be, and you know what the actual status is, and whether we think it's currently going in the right direction, or maybe if there's some changes required. So, courtesy of my day job, I currently have a front row seat to leading financial institutions' engagement with sustainable finance and ESG investing. And comparing what is happening in the markets to what wasn't happening at all as recently as just, say, 6 years ago, there is actually every reason to be hopeful. We are seeing a stunning level of innovation, both in sustainable finance itself, where product innovation is now at a record pace, as well as in fintech, where things like distributed ledger technologies and alternative data, geospatial data, promise amazing solutions to previously intractable sustainability issues. At the same time, for somebody who continues to be extremely concerned about climate change, and on a more personal note, about the world we are leaving behind for our children and grandchildren, I believe that for all the attention that ESG investing is getting in the media, we are only at the very beginning of a much more fundamental reshaping of the financial sector, the global economy, and ultimately the way we all live. Allow me to explain. So before we get started, it is probably a good idea to briefly clarify what is meant by sustainable finance. So I'm using the term to include every part of the mainstream financial system that aims to include sustainability in some way. For example, by making ESG-related disclosures mandatory for companies and financial institutions, such as what we're seeing in Europe at the moment, by integrating those disclosures in the investment process, or by adjusting the aim of those investments to include some ESG-related goals apart from pure financial profits. Doesn't necessarily make fund managers impact investors, but that's exactly the point. Why is it necessary to look at the financial sector at large? Today, the Green Climate Fund, which is an element of the Paris Agreement, has roughly $45 billion in assets under management, making it, according to its own website, the world's largest climate fund. By comparison, BlackRock, the world's largest asset manager, is responsible for approximately $9.4 trillion in assets under management. That's as of the second quarter of this year. We do not stand a chance to achieve the global transition that is required without including the financial sector at large, and doing it in a way that ensures we see real world impact. So with COP28 in the UAE just around the corner, this is actually an excellent opportunity to pause for a moment and to remind ourselves why there even is such a thing as ESG investing or sustainable finance, and to see what we can learn about likely developments in the near and medium term future. So for the next roughly 20 minutes, I would like to encourage you to forget everything you may have heard about sustainable finance. Very often, sustainability in finance is still almost exclusively framed as doing good, even doing well by doing good. That, if you think about it, implies a choice, and I do believe that this is quite misleading. If your house is on fire and your family is trapped inside, it is not a question of doing good to put out the fire and to put it out now before it can spread any further. It's a question of doing what is necessary. And if you happen to live in Canada this year, or in Hawaii, where just a few months ago we saw absolutely horrific images of the worst ever wildfires to strike the island, or indeed in Greece, where we had the largest ever recorded wildfire in the EU this year. Then the image of a burning house that I used just now was actually not a metaphor. Rather, it is what was happening to millions of people all around the world just this summer and the summer before and the summer before. The pictures you've seen just now were all taken during this summer and autumn as the world experienced yet another year setting all the wrong records, such as the warmest September on record. And in all likelihood, we know already that this is going to be the warmest year ever recorded. Let's go back to those Canadian fires. For a while back in June, this is what the air in New York turned into as a consequence of those burning forests. And that is because those fires were by far, the largest ever recorded in Canada. So just let that sink in for a second, just how much worse that was. This chart is actually not showing emissions, but fire radiative power, but it almost comes down to the same. CO2 emissions from this fire alone were roughly 3 times of the emissions connected to Canada's economy in a normal year. So on top of the roughly 700 million tons of CO2 that Canada is, hold on, have we lost the screen sharing? Okay, hold on. Okay, very sorry about that. Here we go. Okay. Okay, so let me, I have a hunch that I missed the original message here, so very, very sorry. Okay. All right. So again, this was the image of the air quality in New York as a consequence of those Canadian fires. And this is the chart that shows you just how much worse the Canadian fires were this year compared to all the ones that came before. And this was the chart that shows the radiative power, but is equally applicable. It looks very, very similar for CO2 emissions. So again, more than 2 billion tons of CO2, 2 gigatons of CO2. Okay, hold on. I'm getting questions here. Sorry. Can't hear the sound. Can we get an indication whether this is there is sound? Okay, cool. Okay. Very sorry about that. I guess with a number of participants would probably have been good to just have everybody in the regular session. Anyway, we'll take that on board for next time. So back to this, enormous emissions as a consequence of those Canadian fires. And that chart just now, sadly, is really, really in line with a lot of other things we've seen in 2023 that are actually really rather worrisome. So what you see here is a chart that shows the global surface air temperature anomalies, as in it shows you how much more or less, how much higher or lower the temperature was in any given month and any given year. Between 1940 and 2023 against a reference period from 1991 to 2020. So what you can see here is that, because it's color coded, right? So you see that in the past, temperatures tended to be lower than 1990 to 2020. And then as you go up, it gets consistently warmer. And then suddenly for the last few years, it's getting quite extreme, in 2023 so far is the most extreme year ever, and not just within these variances that you see here, but sadly really on an order of magnitude worse than anything that we've seen before. So not to be too alarmist here, I'm not saying just yet that this is, the end of the world. We'll have to see whether this ends up being a blip. Yes, we are in an El Nino phase now with regards to climate, and that is going to have an impact this year and next year. But we've had El Nino years before in those years that are outlined here on this chart. And normally an El Nino year should not have led to something like what you're seeing here. Still, as of today, this is a data point, not in itself, this last thick line here, a trend. But here's, as I said, a whole number of other charts, all for 2023, where you see things that are rather extreme as these things go, bearing in mind that this is global systems that we're observing. So this should normally be much more in line with these other gray lines that you see here. And again, the darker it is, the more recent it is. So you can see here again clear trends overall in time. And things like Antarctic sea ice extent, we might think like, well, what does that concern us? If there is a lot of sea ice in the Antarctic, well, one reason why scientists are particularly concerned about that is that sea ice, when it's there, reflects, because it's white, it reflects a lot of light back into space. So when that ice disappears, you get very large areas of sea, of water, that suddenly, from the light's perspective, turn a lot darker. They absorb light, they don't reflect light. So there is, unfortunately, a possibility that you get a feedback loop here, that the more this ice disappears, the more than actually, and that's here, world ocean sea surface temperature anomaly, you might see that accelerating as a consequence of the ice disappearing. All of these things are interconnected. And then, of course, down here you have, yet again, the Canadian wildfires. Another word on that, maybe just to also take it out of this just pure climate context. If the world ocean temperature starts rising or continues to rise as it has, then one of the first casualties will be corals around the world, where we've already seen enormous bleaching events over the last couple of years. And as this accelerates, the die-off will accelerate. So all of these things, as I said, very, very worrisome. And 2023 so far appears to be a year that is in an already relatively critical state, even worse than things that we've seen before over the last 10 years, say, in 20 years. And then, as if all this wasn't enough already, climate change is ultimately actually only the most talked about global environmental crisis. Most scientists in the field usually add at least two more. One is waste and pollution, especially chemical pollution, including plastics, microplastics, and so-called forever chemicals, and the loss of biodiversity, including through deforestation, but certainly not limited to it, and usually referred to as the sixth mass extinction, and the first one caused by us. All of these crises are interlinked with each other, as well as with a similar collection of social crises, including hunger, lack of access even to basic necessities like water, escalating inequality, all resulting, as we see in the news every day, in growing political, economical, and social instability. Therefore, I would like to suggest to you today that our house is indeed on fire, both literally and figuratively, and that the role of sustainable finance is and has to be to steer funds, steer liquidity where it can be used most effectively to put out that fire as quickly as possible. So you may already, if you have been following sustainable finance and how it gets talked about, you may already spot a bit of a difference there, because for quite some time now, over these last couple of years, sustainable finance often gets discussed in terms of like, does it generate alpha? Can it help me make better profits? That may be absolutely relevant for certain, for certain users, for certain players in sustainable finance, but I would like to suggest it cannot be the main purpose of sustainable finance. These problems are what gave rise to sustainable finance, and any successful approach to sustainable finance we should expect of it that it will have an impact on these problems, on mitigating them, and of course, to some degree also on in terms of adapting to them. So what is the state of sustainable finance in 2023? Let's take a high-level look. This chart shows the Principles for Responsible Investing, which is the world's largest organization of financial institutions committed to investing sustainably. As of today, the PRI has more than 3,600 signatories who between them are responsible for approximately $120 trillion of assets under management. Nobody is claiming that all of these assets are invested sustainably today, but all the signatories are committed to improving the sustainability of their investments and to report on this annually. Interestingly, the final numbers, if you see the chart there, then you'll see that the final numbers for 2022 have still not been published. And I have a hunch that might have something to do with the fact that the PRI started last year to also exclude signatories again, as in kick them out of the organization if they do not meet their commitments under the principles. And that's one thing that you can actually expect to see going forward. It's some of these charts that have shown beautiful exponential growth in all sorts of things like numbers of members and assets under management. They may actually start to fluctuate a little bit over the next coming years. And then you may have seen a number floating around that talks about total global sustainable investment now being at around $35 trillion. That's a top level number, which is determined by the GSIA, the Global Sustainable Investment Alliance, which is a meta organization of 7 membership-based sustainable finance groups across Europe, North America, Australia, and Japan. And every 2 years, the GSIA publishes their global review. The last one of those reports was published in 2021, latest one. And as you can see here, $35 trillion means that apparently some 35.9% of all professionally managed assets under management in Europe, North America, Australia, and Japan are now claimed to be sustainable investments. So more than a third of everything, really, because their investment universe is about 100 trillion. So with that kind of money, a third of everything being invested sustainably, we should be almost there, right? At least we should definitely expect to see some significant changes to the ESG bottom line, or at the very least, some trend reversal, something to give us hope that we are now moving in the right direction. So let's take a look. First up, climate change. What you see here is what's required under the Paris Agreement, what everybody still uses as the benchmark, what everybody's talking about when it comes to net zero commitments and so on. The curve on the left side shows you our actual emissions. The straight lines on the right are what is required to reach net zero emissions either by 2055 or 2040, respectively, and therefore what is required to avoid the worst consequences of climate change. What you can also see is that there is so far on that left side here, there's not really a flattening of the curve, of that emissions curve, leave alone any real trend reversal. Also worth noting is that the projected required decline on the right side of this chart will get ever steeper with every year in which we fail to get onto that required trajectory. In the lower left of this and also on the following slides, you can see the Sustainable Development Goals that are immediately put at risk by our failure to move the needle on any given issue. You may be surprised to learn the source for this chart. It's like, this emissions chart. It's actually found in a guidance notice on dealing with sustainability risks by BaFin. That's the German Federal Financial Supervisory Authority who based it on IPCC data. This is not tree huggers. This is not Greenpeace. This is a financial regulator that actually puts this out there. Looking at the rising emissions we have seen on the last slide, it should then not come as a surprise that concentrations of CO2 in the atmosphere continue to rise very steadily, with every year bringing a new record level of CO2 in the atmosphere, which is what gives us the fires and all the other parts of climate change. So what you see here is the squiggly line, if you will, is seasonal variations. So every day in Hawaii, there's a There's an observatory where they just measure the actual amount of CO2 in the air, and due to seasonal variations, you get this little up and down. But then, of course, when you normalize that over, to create an average over time, then there's a very, very clear uptrend that you see. So in spite of any economic slowdown that we saw due to COVID, levels of CO2 in the atmosphere are now between 50 and 130% higher than they have been at any time in the last 400,000 years. And I really, really invite you to let this chart sink in a bit. That last bit here that you see, that steep line there, that is 1950s until today. That's what essentially we've done post-war with, extreme global economic growth, with globalization and all of that. So it's led to this enormous acceleration of output. And to give you the idea, Homo sapiens, as in like our ancestor, actually showed up only about 400,000 years ago at the earliest. So this is what you're seeing there is human history going back to before the Stone Age, going back to the caves. And that last bit is where we are now. So it's quite literally off the charts. Another quick comment on COVID. We did, of course, see reduced emissions in 2020, but according to several studies, that was almost exclusively due to the economic slowdown, which at minus 6.4% for the year ended up being less than originally anticipated and was mostly caused by the initial extreme COVID measures in the first half of that year. By the second half of 2020, emissions were already growing again rapidly. And the latest assessment is that after a very strong rebound of emissions in 2021 to almost 2019 levels, we set yet another all-time record in 2022, with a total of around 36 billion tons of CO2 being released into the atmosphere from fossil fuels alone. And it looks like we're going to set yet another all-time record in 2023. So reducing anything, we are not. For everything, including everything that's happening in the world right now, renewable energy growth, carbon credits, for some reason, emissions aren't even slowing down, and atmospheric CO2 is not slowing down. So in spite of this sustained exponential growth and sustainable investments, such as green bonds, ESG funds, we have so far not even slowed down annual emissions growth or the accumulation of CO2 in the atmosphere. What you see here is those two things actually mapped on top of each other. So you see the white and the orange line, that's green bonds issued, that's ESG managed funds, all in billions of dollars. And then behind as the background, you see CO2 levels rising. So something's got to give. But perhaps the most significant observation here is that even if we look at those temporary 2022 emissions reductions, as if that had been prompted by sincere plans for urgent decarbonization, it would still have been less than what is required under a net zero pathway. And there are already big problems with the concept of net zero, but that is a topic for another day. So even if we had the equivalent of a new COVID crisis on top of a COVID crisis and so on for the next 10 years, it would actually still not be enough to get us on a pathway to avoid the worst climate-related disasters. So that is the scale of the challenge, but also of the opportunity. If you just think about what this means in terms of investments required, there is nothing in human history that actually quite equates to it, but you get a sense like, that something very, very, very large has to happen. And again, it will require the mobilization of the entire mainstream financial system. For now, it looks like those $35 trillion aren't really doing much for the climate just yet. So how about some other critically important issues? Let's look at hunger. Ironically, we were making some modest but steady progress on easing world hunger before that recent rise of sustainable finance. Even through the great financial crisis at the end of the new millennium's first decade, we actually were doing a pretty good job reducing hunger, right? So GFC was somewhere here. So we actually still managed to fight hunger, make some progress there. But just as ESG finance became a thing and started to grow exponentially, that progress first stalled and then reversed. And we are now back at levels in terms of global hunger we last saw more than a decade ago. This means that there are currently, say, between 750 to 780 million people around the world who are going hungry every day. Next, water. 17 countries, home to 1/4 of the world's population, currently face extremely high water stress. And as we continue to deplete aquifers and use more than can be replenished naturally, which is very much what we're doing on a daily basis, this is bound to get a lot worse. And it would take enormous investments just to preserve the status quo. The status quo being about 2 billion people, so 1/4 of the population not having ready access to safe drinking water. And not to put too fine a point on it, while we are looking at this map, thinking about where those 17 countries are. What do people do when they run out of food, run out of drinkable water, get hit by natural disasters? In short, when they have nothing left to lose. What does that do to the countries and the economies they live in? And what does the resulting migration in turn mean for their neighboring countries? These things are not completely unpredictable. We can see what's going on here, and we can therefore see what would be needed in terms of investments, in terms of action to avoid the worst of these outcomes. And to be sure, water stress and water scarcity are by no means limited to emerging markets. You might have seen similar stories a little while ago say, in Australia. It's a recurring topic, actually. You might have seen images last year in California, Lake Mead, which is apparently the main water reservoir for some 25 million Californians, the world's fifth largest economy, getting very close to running dangerously low. What you see here is the latest map produced by a rather fascinating project by researchers at the Technical University in Graz in Austria. And what this map shows is that groundwater levels for most of continental Europe never recovered from a severe drought in 2018. So they can see that in 2018, water levels, the water table actually sank, and it never actually recovered from that event. And this has consequences that are growing ever more severe. So dry riverbeds have significant impacts on agriculture, as well as energy and shipping. In 2022, last year, nuclear power plants in France ran out of cooling water, as in out of sufficient amounts of cooling water. So they had to reduce their output. Similarly, hydroelectric power plants obviously were operating below capacity. And the French nuclear power stations having to reduce their power output, that actually happened again this year in 2023 in the summer because the water was too warm. So meanwhile, low water levels in Europe's main waterways significantly impact shipping, and all of this against the backdrop of an already intense energy crisis in the wake of Russia's invasion of Ukraine. I do hope that I'm making the point that, this sustainable finance, sustainability has some very, very strong real world implications. We don't need to look at this through a lens of doing good. We really, really can look at this through the lens of doing what's necessary and then coming to some pretty strong conclusions. So I could paint a similar picture on food security, soil deforestation, biodiversity, you name it. Again, I do believe we're being shortchanged on those 35 trillion in sustainable investments. So this is where I'd like to bring us back to the financial sector and the urgent need to account for these risks in financial models. What are some of the key issues that need to be fixed, as in relatively easy fixes? And what can financial institutions do to improve these outcomes? Also, beyond just managing these risks, what are the real opportunities this paradigm shift offers? So here's a couple of points. Again, really simple stuff, quite basic, really. One point that's not here, which would really be pretty much the starting point for any meaningful change, is that we would need to see universal and consistent pricing of key externalities. That's currently not even anywhere on the horizon, but it's absolutely critical. If we know that some economic activity does damage and we can quantify that damage to some degree, then we should and need to work that into market mechanisms so that this can be properly priced. But beyond, like, a wholesale change like this, which is arguably going to be difficult to do, a couple of simple fixes would include moving away from voluntary disclosures and voluntary standards, which are still in most parts of the world very much the rule. It's finally changing in Europe, which is why European sustainable investments in that GSIA report that I mentioned earlier actually shrunk by 15% in the report for 2020 compared to 2018. It's a bit counterintuitive, but it's a good sign because it means that the bar for declaring that something is sustainable and investment is sustainable, that bar is being raised. Then there is questionable validity and completeness of data. So very often reporting institutions are left to their own devices. They can pick and choose what they want to report. It's not audited, which is really quite crazy if you compare this to traditional financial reporting. Again, standards are now evolving. Reporting standards are evolving on two main fronts. One is the ISSB, which aims to create a global reporting standard. The other one is one that GRI, the Global Reporting Initiative, does in collaboration with the Europeans to create a European sustainability reporting standard. So exciting developments there. And then lastly, at the moment, we still see a lot of aggregation of incompatible data. And that's probably one of the biggest reasons for the current ineffectiveness of certain types of sustainable finance, such as passive investments in ETFs, tracking early ESG indexes. In an ESG index, you will often find, like, in that scoring of how sustainable a company is, you might find up to like 300 different metrics covering anything from board diversity to emissions, to child labor, to impacts on biodiversity, what have you. All of these completely different metrics go into ultimately a pretty black box, and out comes a single value that determines how sustainable, a ranking, if you will, a rating and a ranking as to how sustainable the company is. And that then gets translated into indexes, and you have the ETFs on these indexes. See where this is going? Like, at the very least, even if we take all the data at face value, it means that somebody is making your investment decisions for you. How big a topic is, or how much should we work on child labor versus carbon emissions? That's embedded in an index as you see it today. I would suggest this needs to be disaggregated. We need to see apples and apples being compared rather than apples and oranges, and we need to find instruments and methodologies that allow investment managers to in a very targeted fashion work on the issues that they want to address. But to hopefully end this short presentation on a high note, the world of 2030 is going to operate on fundamentally different principles than the world of 2023. Bloomberg estimates that the required transformation of the global energy sector alone, just energy, represents investment opportunities in the range of $194 trillion between now and 2050, with required annual investments rising from 5.5 trillion per year this decade to 7.4 trillion a year in the 2040s. And that is not counting similarly gigantic investment opportunities in the preservation of biodiversity, water infrastructure, waste, circularity, nor any of the inevitable investments into education, equality, and social justice. If that does not strike you as a very, very viable investment target and something that makes it very, very exciting to dedicate the rest of your career to, then I don't know what could possibly be big enough. All of us have a role to play in this transition. So your mission, should you choose to accept it, is to use all the financial tools at your disposal, all the power of the financial system to solve the biggest existential challenges that humanity has ever faced in modern times. This may require you to challenge everything, to ask hard questions, to disassemble the whole machine if that's what it takes, and then to put it together again on the basis of new insights, for example, into the nature of economic growth in finite physical and biological systems. I genuinely believe that each of you will make amazing and perhaps even revolutionary contributions to solving humanity's most existential issues. And it's been a real privilege to have the opportunity to speak to you today. And I hope to see some of you in class next year in January. Thank you very much. If there's any questions, I'd be very happy to take them, time permitting. So that would be the end of the presentation. Thank you very much. Two questions. Open, here we go. How do you differentiate, Angus, thank you very much for the question. How do you differentiate between greenwashing for ESG and gaining marketing points versus genuine sustainable investment and change? Right, so that excellent question goes right to the heart of what I would actually call a bit of a crisis right now, as in, I usually in class, I refer to almost everything that we're seeing at the moment as ESG 1.0, pretty much like there once was an internet 1.0. And we're going to see evolution. A lot of it, in my mind, what's happened so far, I would genuinely suggest that the true greenwashers, the people that put something out there saying it's green when really they absolutely know that it's not. The greenwashers are actually in the minority. I truly believe that. It happens for sure. There's companies out there that are committing occasionally some rather atrocious acts of greenwashing. But if that makes sense to you, the bigger challenge at the moment, I would say, is actually green wishing. I haven't come up with a term. If you Google it, you can trace it to the source, which is on some level, we very much want these things to work. So one example where we started off on a conversation that was all positive and we're seeing great growth, especially in China lately, is electric vehicles. So that was originally framed as like, a fantastic thing for sustainable finance, a fantastic thing for emissions reduction, etc., etc. And then when you look at it, for one thing, an EV will only ever be as green as the energy that goes into it. So if the energy that gets used to charge an EV, say in Indonesia, comes out of a coal-fired power station, then you've not reduced any emissions. And then, of course, you get a whole host of other new impacts that are not necessarily immediately climate-related, but equally problematic, such as on the biodiversity level, on the water, with regards to the water topic. So I think, if I'm not mistaken, processing a ton of lithium to be used in batteries requires something crazy like 2 million liters of water just to get it ready for the market. So to answer the question, how to differentiate, honestly, at this point in time, by the financial institution or the corporate displaying a greater than average level of transparency and showing that the organization is truly committed. And that's not in lovely statements and glossy brochures. That comes down to, does the C-suite, for example, have sustainability-related KPIs, hard KPIs, as part of the remuneration structure? Is the company missing its sustainability targets actually going to lead to management taking some financial hits, right? So that sort of thing is a good indication. It still doesn't guarantee it, but it certainly, to Angus's question, would help to differentiate a little bit between the ones that are jumping on the sustainability bandwagon and just want things to look nice, and the ones that are really wrestling with the topic. As I would hope the last couple of slides may have made it clear that we're really dealing with what some refer to as a polycrisis. So there are no simple solutions. Do you see, anonymous attendee, do you see any strategies in the banking industry that are making an impact to adapt and mitigate climate change? A cautious yes. Actually had coffee with a good friend today here in Singapore, who works in a senior function at a European bank with strong ties into commodities business and all of that. And the bank is seen as a leader in the sustainability space. And he nonetheless said that for all the genuine engagement that he sees, and he speaks to lots of his colleagues, and they are genuine in their desire to do something. But when it comes to then actually putting deals together, he says that very often traditional risk concerns take the upper hand. Like, so, okay, we are committed, we want to do this. But how do we then actually sell this additional risk that we might be taking on board by investing in something that isn't as liquid as the traditional instruments, or by making a commitment to methodologies, instruments that haven't actually been tested or haven't gone through the same evolution as mainstream financial instruments? How do we then actually reconcile that with our rather conservative risk management ideas and risk management frameworks? And the answer is very often at the moment, you can't. So again, in this case, if you want to look at various banks and how they deal with this, I would encourage you to really go reading between the lines, and to some degree look for the same things that I mentioned earlier, like, responsibility for sustainability related KPIs, consequences of missing the KPIs, and then see what comes out of it. If you want to look at a bank that in my mind is really trying to push this as far as they can, that would be Triodos Bank, a bank that actually features in one of the case studies that we look at as part of the course. So yeah, I hope that answers the question. And I'm not entirely sure if there's other questions. Happy to answer any others that come up. Otherwise, I guess, Zul, I would hand back to you. And thank you again very much for attending, and hope to see you in class. Thanks a lot.
Thank you very much, Stefan. That was Stefan. Thank you for a very insightful presentation. For all the attendees that have attended this webinar, thank you so much. We hope if you join the program, but if you do have any other questions, please do not hesitate to contact our students or our representatives from ASEC Asia Pacific. In the meantime, thank you so much for attending once again. Have a good night. Thank you, Stefan. Have a good night as well.
Thank you very much. You too. Bye-bye.